Good morning, everyone. Firstly, I would like to wish all the women members of BVA a happy Women's Day. I would also like to thank all the participants for joining in this wonderful session today. We at BVA are committed to providing you excellent topics on every second week. And again, I expect this to be a wonderful and very exciting session by today's speaker. Today's speaker is CA and Registered Valuer Nitin. Uh, I had the opportunity of being one of the co-panelists with him in one of our earlier panel discussions. And CA Nitin brings in a world of experience in the field of valuation along with his chartered accountant practice. He has selected a very specific and very niche category topic today, which is valuation of hospitals. I am sure he will be enlightening us with some key interests about the topic. Nitin sir, thank you for joining us today and kindly take over.
Thank you, Neeraj sir. So I hope that I'm audible to all the members.
Yes,
And
sir, you are audible.
okay, thank you. So at the outset, I would like to thank the organizers of BVA, especially for inviting me to this particular webinar. And uh, I take this as an opportunity to present my thought process on this particular topic on valuation of hospitals. Uh, I'm also grateful for the fact that I have been allowed to choose a particular topic on my own, and uh, I landed in this particular topic. Uh, so the reason why I chose this topic is because my very first valuation engagement was uh, regarding valuation of a hospital. So this was the first assignment which I got as a valuer after I qualified the examination. I used to do valuations earlier as a chartered accountant, and since the regulations changed subsequently, uh, registered valuer's qualification was mandatory. And after undertaking that qualification, this was the first assignment which came across. So I thought that it would be appropriate to discuss uh, valuation of hospitals in today's webinar. Now, when I got this assignment, uh, I went through the annual reports of the hospital. So the instinct of a chartered accountant generally will kick in with respect to going through the annual reports first before, uh, in fact, getting into this assignment and starting the planning. So when I went through the annual reports of this particular hospital, I found that the hospital was undergoing a very bad phase with persistent losses as per its financial statements and negative net worth. So my very first assignment as a valuer by undertaking the various approaches like income method, income approach, cost approach, market approach, etc., resulted in a big challenge initially with a loss-making organization. Now, we are generally inclined to the fact that service industries would prefer income approach better due to its income earning potential rather than the asset capitalization, which probably it may not have because of the nature of the industry. But when it comes to hospital, it can equally be capital intensive as well. So this was a challenge which I had to face initially in the first assignment with respect to choosing the appropriate method. Now, the hospital was making persistent losses, which made projections a bit more challenging in the sense that when the hospital will come back to profitability was a question which even the management had significant doubts. But they did not have a plan to wind up this hospital or to sell the hospital outright. And they still intended to continue this hospital forward as a going concern. And the assets of the hospital had good value, and the hospital had immovable property on its own as well. So this, in fact, doubled the challenge of choosing the right approach for valuation, where I should be honest with you that my experience till that particular stage was more into income approach rather than the market approach or cost approach. So I was inclined to adopt that particular approach, but even then it had its own challenges. So as per IVS, which was prevalent at that point of time, weighted average was possible, which subsequently, in fact, got amended by IVS 2022. And the recent IVS 2025, which is applicable post 31st January 2025, also prohibits averaging. Rather, they prefer us to reconcile the values under multiple approaches that we adopt. So initially, I was thinking whether I should adopt a weighted average method for income and cost approach, because of the particular nature of this assignment, where the hospital was uh, undergoing losses, and the profitability was a distant future as far as the hospital was concerned. Now, I had an advantage as well. Just like whatever challenges are there, it provides us an opportunity as well. So in this particular situation, I had an advantage that the valuation was being done for the purpose of a statutory compliance, which is private placement of shares. So this statutory compliance requirement of valuation provided me an advantage due to the provisions of Companies Act 2013. The obvious advantage which I have is that the hospital management is aware that the valuation will be negative. I am aware that even after I adopt all these methods of valuation, the end result would be negative valuation. And the investor also has an awareness about the present situation of the hospital. So, which provided me this uh, assurance that whatever I do, eventually the shares are being issued at face value. The provisions of Companies Act do not permit issue of shares at a discount, and the shares needs to be compulsorily issued at a face value. So this had an advantage to some extent, in the sense that the shares are anyway going to be issued at face value. So whatever valuation I perform, I know that the result will be negative, and also that the shares will be issued at face value. So this slightly reduced the challenge in this valuation assignment to some extent. So when I proceeded with this, I decided to consult the auditor of the hospital, because in addition to the management's intention, I thought that it was appropriate to seek the opinion of a qualified professional who audited the financials of the hospital as well. Because I discussed that the hospital is undergoing persistent losses, and due to this particular reason, whether the going concern of the hospital is affected or not was a big concern. So, as we all know, there are different valuation bases to be adopted, and liquidation value is also one important base which we may have to consider, depending upon the intention of the organization undertaking the valuation, and also the regulatory requirements as well. So, my first challenge was to establish whether the hospital will continue or whether it will not be able to continue in this current state. So for that, I even consulted the auditor, who gave me good insights about the way in which the hospital was functioning. And this is the point of time where I would get into an interactive mode, where I would also like to seek the opinion of the participants, many of you who are more experienced than me as well. So when it comes to the assignment of valuing a hospital which is undertaking severe losses, there are few points which I observed in that particular assignment. And some of these observations would require your opinion as well. So the assignment is already over long back, but some points are still relevant as it stands today. So I observed one aspect that the hospital was predominantly owned and maintained by doctors. Like most of the hospitals would have doctors at the top management, but this hospital had only doctors in the top management, director board, shareholders as well. Everybody were doctors. There was no person who was not a medical professional in the ownership and management of that hospital. So what do you think would be the advantages of such kind of an organization structure? And what do you think would be the demerit of having only doctors in the top management of a hospital? So I would like to get the opinion of members. And since this is an early morning session, at least I am still in the mode of waking up process, and being a speaker helps me to be awake, obviously. I would like the other members also join in this conversation. So, what do you think would be the advantage when the hospital has only doctors as the owners and management? And what do you think would be the disadvantage?
Hi Nitin, this is Subbarao. Even I have done one hospital valuation where, as you said, okay, the capital intensive is more okay, like similar, and even the company also into losses. Okay, and also this is again for issue of shares only.
Yes.
Even we have seen both valuations, and okay, like we have given the price because that is not a statutory compliance. They want to know that okay, they want to issue some ESOPs. Okay, yes, as you said, it is very challenging. Okay, which method you have to adopt, as well as again, yes, usually 90% of hospitals, both shareholders, directors will be the same doctors. Okay, again, we have to see that investor who is coming, whether they are issuing to the same directors or shareholders, or who is the investment, and again we have to see.
Yes. So presently, the investor was also a doctor. He was also a medical professional. So
Okay.
generally, doctors, provided the extent up to which they get successful, they start expanding. And I have seen many hospitals which started from a small clinic and which got developed into a super specialty hospital. So many of the hospitals are, in fact, developed in that fashion. So predominantly, it will be doctors who will be owning and managing the hospitals. But some hospitals adopt the method of having other specialists also in the management, because it is not just about medical profession. You need to manage the finance as well properly. So I have seen hospitals where some of the directors have the specialization in finance, and generally these hospitals are supposed to do well, or do better, because doctors, obviously their core area is medicine, and commerce is not exactly a topic which may always go along with medicine. So that being the case, this hospital had a big challenge in the sense that only doctors were there in the management. And as far as a valuer, I found it difficult to convince certain valuation concepts and methods to the management because they were entirely medical professionals. So even the finance team had one or two qualified professionals in finance, but they did not have much say in the management. So as a result of which, it was predominantly the doctors whom I had to convince for the purpose of this valuation assignment. And it was very difficult even to explain that the issue has to happen only at face value as per the provisions of Companies Act. So they were wondering why the law actually do not provide that benefit to the investor. Why should the investor end up paying some kind of a premium by issuing the shares at face value when the organization is running at a loss? So these were the initial challenges which I had in undertaking that particular valuation assignment. And I did adopt two methods. I adopted income approach as well as the cost approach for this valuation, because the hospital had significant asset base as well. Even though it was running at a loss, it had significant asset base, due to which I was initially wondering whether the cost approach would result in higher valuation. Though both valuations are negative still, but even then, possibly there is a situation that cost approach will provide a more appropriate valuation.
Hi,
So the
sir, Shyam here.
yes, good
Sir,
morning, sir.
how will a DCF valuation become negative? I mean, I'm never able to understand,
Uh,
because I have just recently valued a hospital for a very high price and just allotted the shares. So any company, even if it is a loss-making company, even if you have crores of loss, the valuation future will be always, I mean, positive for everybody, right? From the management point of view. So it'll automatically become positive and it'll have a higher value.
okay, okay. This is one obviously a very important aspect with regard to the income approach, where generally everybody will presume that the any organization, not just hospital, any organization will proceed with better profitability in the future, and it depends upon the projection period as well as the growth rates which are being adopted in that particular situation. So it can take longer for some loss-making entities to come to the profitability situation. So what
Mhm.
happens is that possibly in 5 years period, the hospital still not achieve profits, but the projection period obviously has to be longer, in the sense that 10 years, 15 years, or probably even 20 years for a reasonable assumption of profitability being achieved. So that was the kind of situation this particular hospital also faced. And that you have the concept of terminal growth rate, obviously. So terminal
Yes.
growth rate can never be negative. And if that is the assumption, then the hospital will go forward. So I assume this is the precise point that you are making.
No, sir, because if I have time, I can tell you because I was a finance controller of Narayana Hridayalayah almost 15 years back. Okay. So I know how the EBITDA things work and what is because the hospital will never make loss unless you have a very huge fixed burden. Okay. And that too, the majority of the fixed burden is going to the doctors. As you say, the management is considered of doctors. So they are always ready to compromise on their component because nobody is going to come to a company as invest if it is not going to give them at least the return in the EBITDA, I mean, in the DCF valuation, right?
Okay.
Sir, sometimes even DCF valuation, even it is not a hospital, even other manufacturing companies also, DCF will give negative. It is not that DCF means always positive and will get positive value because the higher interest rates and whatever this expenditure are more, you may get again negative terminal value, not negative terminal value by deducting the debt. Because if the even the company is having a terminal value or whatever it is, enterprise value, the debt is more, obviously negative will come.
Yeah.
But it will, sir, Shyam sir's point was basically that the investor would obviously see something positive, and otherwise he will not invest if the return will be
Exactly.
negative. So
Yeah.
that is exactly the point which is being made. But here
Sir,
again,
may I?
yes, sure.
Yeah, thank you. Sir, what has happened is in my case, I had I've been doing the valuation for the past 2 years for a hospital from India's perspective. But why negative in between? Say, hospitals primarily they undertake this loaning activity, and specifically in being capital intensive kind of units to start with at least when buildings and major equipments have to be purchased, they borrow extensively. So those borrow cost will keep on reducing, and they reduce, let's say, in first 4 5 years. So in case you opt for a period, say 7 8 years now, after 5 years of that loan repayment, loan will become practically nil. So whatever loan post that they would be opting for, that would be for let's say some working capital kind of thing, or not even working capital, because hospital patients pay them simultaneously, whereas the hospital in turn gets the Jana things on credit also. So the working capital requirement also is not all that high for them. Say that routine loan or those in turn loan they will be taking, that will be a kind of say minuscule amount of it. That's how the in the terminal value at least no loan will be appearing, and because no loan, no interest, etc. will be appearing, and terminal value is going to be positive, and that's how this DCF value, even if for 4 5 years, hospital is having negative returns, so it will be return having TV as positive, and that's how DCF two will be positive. That would be my limited submission out here.
Yes.
Okay. So I agree with the fact that DCF is supposed to be, in fact, coming out with a positive value as the outcome. I will take the percentage as 99%. So 99% of the cases, my opinion is that DCF would result in this positive valuation. But the current situation, like depending upon the projection period, do the valuer have the, let us say, privilege to change the projection period different from the intention of the management? This is one question which will definitely come up. In this particular case, the extent up to which the management can project and provide the projections has a significant influence on this particular valuation as well. There is a limit or line which we need to draw to the level up to which we can question the assumptions of the management. We can question the reasonability of the projections. We can question the pattern in which they have projected, whether adequate competence has gone into preparing the projected financial statements. But the intention of the management to carry on the hospital up to a particular period and the kind of return that the investor expects. What I understood was that the hospital's asset base is a big advantage which the investor did have in mind. So what the investor did have in mind was that whatever be the case, the hospital has an intellectual value in the form of the know-how, and also the asset value in the form of immovable properties which will never depreciate. In this particular situation, the hospital was functioning more like a government enterprise, like a public sector enterprise, which has a lot of assets, but the operations are not running at a profit. So this was the kind of situation which even this particular hospital, which I valued, was it. But the subsequent valuations which I did was with respect to hospitals which had significantly higher profitability and much more profitability than many other service sector enterprises as well. So but this being the initial assignment, it was a big challenge for me. And I was also wondering whether the DCF would result in negative valuation or not. But based on the projections and the assumptions which were made, like Venkata sir, Subbarao sir hinted, see, the debt, the position of liability, we cannot project the debt for the future. We are talking about the valuation as on a particular date. So I did look at the possibility, and then finally, I also came into an opinion that DCF can result in a negative valuation as on a particular date. But as far as the investor is concerned, his big advantage was that he is taking over an existing infrastructure. Like Rajiv sir indicated about the fact that capital intensive nature in the initial years can sometimes result in the initial period of losses, operational losses as well. And subsequently, it would definitely come to profit. It is only a matter of time. So the hospitals will generally not incur losses in the long run. So I agree with that particular viewpoint, definitely. The hospitals, it
I
might
had one more similar instances where,
yes,
as you rightly say, the hospital had a huge land bank which was used for parking.
yes.
Okay. So in the valuation, what we done is we have valued the land separately. We got the valuation of the land and we added the land valuation to the DCF valuation
Oh, I see. So,
because the land was not used for the business. So the land value was very high.
oh, I see.
And
Oh,
it is a huge FIS has invested in this hospital recently only. So we have done that, and dilution is very huge. It's not like small also. It's very big.
okay. That provides me a new information with the income approach along with the value of an immovable property being added to arrive at this valuation.
Because
So,
we proved that we are not using the land for the business purpose.
okay. Okay. So anyway, this is one method possibly. So if you add up the assets, obviously the hospital had this advantage of having the movable property, which will always appreciate over a period of time. And in fact, this requires the help of other registered valuers as well. Technically, under the cost approach, obviously, even I had sought the help of other valuers because land and building and plant and machinery both require valuation by the respective RVs asset class of the same asset class, I think. So anyway, I had compiled both, and what happened was that financial assets were almost non-existent in this particular situation. The balance sheet did not have strong working capital position, and most of the financial assets were not realizable at all. But still, the immobile property had good value. Okay, so now I began with this particular case study primarily because uh, I just wanted to explain the reason why I chose this topic, and I'm glad that few members have already started sharing their expertise and viewpoints. And over a period of time, I'm sure that I will also end up taking new points, and I may value the hospitals better. So I have also prepared a PowerPoint presentation which I will be now getting into. But before getting into the presentation, let me tell you that a hospital is a place which I would never like to visit. I would like to avoid it at any cost, and I hope that none of you end up in hospitals for the purpose of consulting a doctor. Rather, we would prefer to go to hospitals for other purposes, like for valuation, for example, or for being appointed as a consultant or auditor or even a finance officer of that hospital. So I wish that all the members have a healthy year ahead, and that you will not go to hospital for diseases, rather you go to hospitals for other beneficial purposes probably. So let me share my the PowerPoint presentation now. Okay, so I hope that the screen is visible, and we will proceed.
Yes, visible, sir.
Thank you. So I propose to discuss in this format, which is introduction, basic introduction, which I have already given, and the challenges which are involved. that too I have shared to some extent. And in fact, with the interaction of multiple members, now we have come across multiple situations where there are challenges in the valuation of hospitals, and obviously the choosing the right valuation method, income approach, cost approach, market approach, etc. One thing which we are clear is that averaging is not possible. We need to adopt each method independently and arrive at a valuation as per that particular method. And we need to perform this reconciliation as to which approach is better and which approach is most suited for the particular entity, and for which IVS also provides us some insight. So IVS 2025 also has in fact deliberated upon which method is appropriate in which circumstance. So income approach is adopted primarily in cases where the industry's income producing ability, I mean the entity's income producing ability is the subject matter, and reasonable projections can be made. Whereas the cost approach is more suitable for, let us say, more capital intensive industries where, in fact, the intention of the seller can also play a part in this particular situation. And talking about intention, that brings me to another question. Whether valuation should be done taking into account the intention of the seller or the buyer, in the sense that whether we should take into account the intention of the entity, which is the hospital in this particular situation, or the intention of the investor in taking over the hospital. So probably the promoters have an intention to wind up or sell out this hospital to another person, while the investor can have an intention to take it forward as a going concern. So as far as a valuer is concerned, what would be your opinion? That is, whose intention needs to be given preference, whether it is that of the entity or the investor?
Entity.
Yes.
Entity, sir, because the entity is only engaging you.
Because primarily it is the entity who engages you for the purpose of this valuation, and we cannot go by the intention of another person who is an external party, obviously. So this also contributes to some kind of a challenge where the intention of this entity might be to wind up, while the intention of the investor can be to take over by purchasing that hospital outright. So this can also be a situation which can arise. So in this particular situation, the management continued in the first assignment which I took. The management continued, existing management continued, and another additional investor came in for support. So this, in fact, gave me further assurance that everybody intends to take this hospital forward as a going concern. Only that they did not have a clear idea as to when the hospital would come to profitability. The investor was interested for long-term investing, and obviously they had no clarity whether it will achieve profit in 5 years or 10 years. They had significant doubt in this particular situation. But even then, you have to go by the going concern assumption. So primarily, I adopted the going concern as one of the important assumption in this particular case as well. Primarily because of the immovable properties as well. So it can come back to profitability through other methods as well. So it was possible. Now, we will also discuss some key financial metrics. Now, what happens in this particular industry is that even though you can club it under the service sector, there is significant elements of goods as well in the form of medicines which are supplied by the hospital. Primarily, the hospital is a service provider, and the hospital supplies medicines as an incidental part of providing the main service, which is healthcare. So there are some financial metrics that we need to consider, especially under DCF method when we prepare the projections, where you have to consider goods as well as services. And I will explain in detail in subsequent slides. Now, what are the market trends which are affecting the current healthcare industry, which has an impact? You know that everybody have become doctors due to artificial intelligence. Even Google used to be the doctor for some of the ailments earlier. And this artificial intelligence has resulted in significant impact on the healthcare sector, where a lot of people have started treating themselves. And probably I look at it as an opportunity for hospitals as well, in the sense that they can also develop their own interactive platform. That is one opportunity. Another opportunity is that people undertaking the self-treatment complicates things and again end up with hospitals. So whichever way, the hospital should look at it positively as an opportunity with respect to the technological trends which are there. And I have also taken the annual reports of some hospitals, which I have not named in this particular slides, but I have just taken it as hospital 1, 2, 3, etc. And I would again involve the discussion of, multiple members by looking at the figures and providing your inputs on the analysis as well. And finally, whatever questions which may arise subsequently, that can also be taken up. So primarily, the purpose of valuation of a hospital can be generally for statutory compliance, or it can be for business decisions. So there is another hospital in which I had engaged as a consultant, not as a valuer. The valuation was done by another professional, but I was engaged in this particular hospital assignment as a consultant. So what I found is that this is a classic case of one person developing an enterprise, just like a unicorn gets developed in startups. So this particular medical professional had a very small clinic with just a very small area, and he had one specialization, which is IVF, which is fertility related specialization. Now, what he did was that he started with a very small clinic, but in 1 year, uh, he had significant visitors, patients, and he decided to expand it in the form of a hospital. So he was able to bring in the investment to uh, start a hospital from the revenue earned from the consultation as well, just in a span of 1 to 2 years. That was the kind of growth which was witnessed. And in fact, this clinic became a hospital, and this hospital actually started developing the entire surroundings. In fact, that is the story which I witnessed there. Obviously, when a big entity like a hospital comes up, there will be incidental establishments which will get established in that vicinity. So this hospital had a big impact on that particular area. And I found that even buses started stopping right in front of the hospital. A new bus stop was constructed after this hospital came into that particular place. And that was the kind of change which this hospital brought about. And in 3 years, he achieved to collect 400 crores as part of dilution of his stake in that particular hospital. So this is an amazing story, especially when it comes from Kerala, where the size of the industries as compared to other metros would be significantly less. But in 3 years, this hospital managed to gain this 800 crores valuation. And the owner of this hospital got 400 crores in his pocket for 50% dilution. So how this was achieved? Primarily because of the core competency. So I can generally say that every entity survives because of the core competency, and finance also needs to be managed properly. But when the core competency is there, it addresses that problem. Even as chartered accountants or valuers in other fields, we have seen this. Our core competency would definitely help us to earn revenue, even though we may not pay too much attention to financial management in our own offices. So I can honestly admit that as a chartered accountant, I did not have to bother much about financial management in my office, because it actually had a way of happening on its own. So generally, I have not applied projections. I have not calculated break-even point for my office. I have not calculated IRR, NPV, or I did not try to value my own enterprise, my own CFO, because it automatically grew every year over a period of time. And this is what can happen to some of the entities as well, like hospitals. Now I'll bring it back to the hospitals. So some of the hospitals function, or most of the hospitals function based on the core competency. There will be generally one person or a group of persons or department which does extremely well in that hospital, and that becomes a reason why other departments also gets included in that hospital. The hospital starts expanding and diversifying. So 90% of the cases of hospitals which I found, especially private hospitals, obviously, functions in this manner. So there will be one doctor who becomes, let us say, expert in that particular domain, and there could be other doctors in the same department. It can be any kind of specialization, and the hospital grows into other specializations over a period of time. So the reason for valuation can be statutory compliance or business decisions like these, which result in automatic expansion. And it can even be for internal assessment. I am not sure how many valuations have been done by members here for internal purposes, purely for internal purposes. Generally, it will more on the higher side for statutory compliance and for the business expansions, etc. So anyway, this internal assessment can also be one reason for valuation of hospitals. Now, what are the challenges? I can say that these challenges are common to all the industries, not just hospitals, but nevertheless, being a service sector where intangibles can also be high, this is very relevant. So understanding the nature of industry is very important, regardless of which entity that you undertake for valuation. There is an intellectual value which obviously comes across, especially in service sector, and more so in the case of a profession. When compared with the business, a profession goes by intellect more, in my opinion, whichever profession that we look at. So the intellectual value needs to be given more significance when we get into service sector, which is into some kind of a profession. It can be medicine, legal, engineering, it can be finance, or any kind of profession. Then choosing the appropriate method. I have already discussed this. Market approach is the easiest approach for listed companies, probably, but for unlisted enterprises, it poses significant challenges as we have experienced in the past. And we may be inclined to adopt income approach or cost approach for unlisted entities due to this particular challenge of getting the information. And it is not basically the information, but it is converting that information and adopting the appropriate multiples to suit this particular entity. That becomes the greatest challenge there. So, and the final challenge is regarding preparation of projections and the discount rates that we adopt. So even though this is common for all the entities when we adopt DCF or any other method for valuation, as far as the hospital is concerned, there is significant challenge in the sense that unlike a business enterprise, like you can, if you sell goods or commodities or provide any other kind of services, you can have a plan or assumption in your mind that you will achieve 100% growth rate over a period of 5 years, 10 years, etc. And you can grow further. But this is something like an essential service. When we are talking about hospitals or healthcare, we are talking about essential services. So do the hospital also project in such a manner that it will have so much footfall in the first initial year, so much footfall in the subsequent years, etc. Or will it adopt a different approach? So this is another aspect which determines the preparation of projections and assumptions of discount rates, etc. So I was just touching upon the brief areas, this being the introduction slide. So let me try to get into the specifics of each of these points as much as possible. Now, these methods are familiar, so it does not require much extensive discussion. But primarily, income approach focuses on the income earning potential. Market approach focuses on, let us say, having reasonable comparables. And having reasonable comparables and the similar situation will enhance the adoption of this particular method, and it will have much more impact. It should be more appropriate when the comparables are easily available. Now, cost approach focuses on the value of the assets as well. So, not just the income earning potential. So, a balanced approach can be done by adopting multiple approaches and determining which is suitable. But at the same time, averaging cannot be done. Now, how the data flow happens in hospitals. So let us now get into the industry-specific considerations. As far as a hospital is concerned, you all know that it is about generally business to consumer in nature. It is B2C model of data flow, where obviously it is the public which will be the biggest beneficiary of hospitals. Though there could be B2B transactions as well in hospitals. So predominantly we are talking about B2C, and there could be some portion of B2B. That is one way of looking at the commerce aspect of data flow in hospitals. Another way of looking at it is like the hospital has two important areas to take care. One is about the patient management system, which will be the core area, and the second will be the accounting system. It is possible that the hospitals may have different packages or softwares for the purpose of management of patients and for the purpose of accounting. Or it is possible that the hospital may invest in an ERP package which suits both the requirements. which manages the data flow of patients as well as the accounting systems as well. So as far as valuer is concerned, extracting information and the effectiveness of the information that we extract depends upon the kind of system that the hospital follows. So it has a big impact on the extent up to which we can extract information from the entity. Suppose there is a separate software for the patient management system. Now we are supposed to look at how this information gets translated into financial figures as well. Technically, I speak in the capacity of a chartered accountant more. So land and building valuers and plant and machinery valuers should also keep this assumption in mind that I predominantly talk based on the my area of expertise, which is that of a chartered accountant, and that is why I convert it into financial figures when discussing about all these aspects. So, how to extract figures for the purpose of projections when the hospital has two different softwares? You can look at this way that the management will anyway provide us the projections, but how to validate those projections to the reasonable extent possible. So we may have to study the system as well properly as to how the hospital manages the flow of patients as well as converting that into accounts. So if the softwares are independent, which is a patient management software is separate and accounting software is separate, this increases the challenge for the valuer. What happens is that typically, let me look at the situation. Every patient gets a customer ID or a patient ID, and then this patient ID is the basis on which every transaction happens with that patient. And now what happens is that whenever a billing happens, this information needs to be either migrated to the other software or it needs to be exported from this particular software and translated to another software, which needs to be imported back into the accounting software. This significantly increases the complexity as far as the hospital itself is concerned, and this increases the challenge as primarily, I will look at let us say the internal control system for which we will get information from the annual reports, and to some extent, the hospital already has auditors who will take care of the reporting on internal controls aspects as well. So that is one source of information. Then obviously interaction with the management. This will give us an idea about the extent up to which the hospital depends upon these accounting systems or ERP softwares for patient management, etc. While we can take it as a challenge, we can also look at it as an opportunity to gain experience as well. Now, when the softwares are, let us say, there is only one software. I mean, both the patient management system and accounting system happens in one single software. Then we can definitely study this particular software and extract information better. So this is one possibility of a challenge which I can find in hospital valuation. Another aspect is nature of specialization. Not every hospital specializes into every area. What we find is that there could be hospitals which are multi-purpose hospitals where you can go for any kind of, let us say, purpose requirements which need not be confined to a particular specialization. While there are specialty hospitals as well. So we need to give weightage to the nature of specialization that this hospital is into. It can be like eye hospital, it can be a dental hospital. So each of these specializations have its own nature of revenue streams and the methods of capital investment and even projections depend upon the nature of specialization that the hospital is into. And even in other hospitals, what we find is that not all departments have the same profitability. If you get into the profit centers or cost centers, what you will identify is that there are some departments which function extremely well due to the kind of core competency that the medical professionals possess in that particular area. While there could be other departments which will be running at a significant loss. So it is possible that the combined effect is still positive. So as far as valuers are concerned, while looking into this particular specialization, we need to give adequate weightage to the core area which brings revenue to the hospital. And at the same time, we should keep an eye on those departments which are not bringing enough profits to the hospital. And we need to get the intention of the management clear. Most of the times, management will say that we cannot function as a hospital in just specializing in just one particular department. It is possible that it necessitates the inclusion of another department, in the sense that depending upon the area that the hospital chooses. So these departments have to be retained, irrespective of the fact that whether it is running at a loss or not. These departments still needs to be retained, because that also contributes to the profitability of the other department, if not so for the relevant department which is still incurring losses. So that was another insight which I got by evaluating some of the hospitals, where I found that there are some departments which are retained only for the purpose of supporting the other departments, even though this particular department might be running at a loss. We need to project sensibly in such situations. Now, as far as patients are concerned, again, there are further situations of inpatients and outpatients. So this has a significance as far as the valuer is concerned, because what happens is that an inpatient requires probably more, let us say, duration of service, definitely, and it also involves admission into the hospital, then the related revenue sources of room rent and other factors also will come into play. Even insurance, etc., will come into play. Whereas, as far as an outpatient is concerned, probably that patient is there to seek medicines and go home after availing that particular consultation of the doctor. So this again needs to be projected independently, in my opinion. So generally, hospitals are aware about this particular division, segregation, and most of the softwares will provide you this data of IP and OP separately. What I have seen is that all the hospitals have different softwares, and they don't technically go into the same software, which is what I have found. But even then, all these softwares are configured to capture the information of inpatient and outpatient separately, because anyway it is required for the purpose of the basic functioning of the hospital as well. So we need to look at the inpatient and outpatients separately. And what happens is that what is the combination of service which we provide has a significant impact on the projections. So it can be diagnosis and medicine only, or it can be diagnosis plus admission into the hospital, along with supply of medicines and the related services, like it can be diagnostic laboratory services, and it can be insurance claims as well. So this is one industry specific consideration that we need to keep in mind while valuing the hospitals. So how to do this? The primary step that we need to undertake is to get into the deeper cost centers and cost units as possible. We need to get into the lowest cost unit, and that is what will help us to carry out this process. And this will help us to start the projections or validating the projections with better assumptions, rather than adopting a blanket 10% or 15% growth rate, which is a primitive method of valuation, where you only take the total revenue and apply a random growth rate by taking the past trends. Even though the past trend can indicate something like 10% growth every year in overall revenue growth, still I would not recommend adopting this blanket growth rate to the total revenue of the hospital, which I suppose that you all will agree. So we need to look at the cost centers. We need to further get into the type of services, and we need to segregate goods and services to some extent as well, because supply of medicine and supply of services needs to be treated separately, and the growth rates and projections can vary significantly in all these situations. Now, this is the aspect that I was already mentioning with respect to services and medicine. Now, in the previous slide, we were discussing about the inpatient and outpatient distinction. Now, we are looking at the service and goods distinction. Technically, goods are incidentally supplied along with the services as far as a hospital is concerned. But at the same time, it is possible that the hospital also undertakes sale of goods as a independent transaction, where I have seen situations where a hospital can have transactions with other hospitals, which can be in the nature of goods as well. So there are some situations where there can be goods transaction, and there are predominantly the cases where it is services and goods are incidentally supplied along with the services. So these are the two situations where we need to again project separately. So we need to obtain this information about revenue. In fact, what I find is that obtaining information about revenue and the revenue streams is very, very important when it comes to the service sector, because the entire projections depend upon the method which we adopt for projecting the assumptions. I mean, carrying out the valuation based on the projections and the assumptions. Now, a hospital can have several allied services as well. It need not always be the healthcare service for which the hospital may earn revenue. There could be several allied services which you can think about in a hospital. For example, many of the hospitals have a canteen facility. So this canteen facility also brings revenue through the hospital. It may not always be significant. If we observe the hospitals, we may find that the canteen fetches a very significant, insignificant revenue when compared to the healthcare revenue. This could be even less than 5% revenue, which may come from the canteen. But in some cases, I have found that the revenue can be more than 10%, these allied services. So depending upon the proportion of the allied services, we need to give appropriate significance and importance to the such revenue streams as well. So laboratory is another, let us say, facility where some hospitals allow you to use the laboratory without registering as an inpatient or outpatient. So most hospitals would prefer only registering and then availing these services. What happens is that this laboratory service can be an independent revenue stream in some of the hospitals, depending upon how the hospital functions. And I have seen that the laboratory is provided as a facility to other hospitals. So other hospitals which do not have this particular facility may use the service of laboratory in this particular hospital. So it is a direct transaction between a hospital and another hospital, rather than a transaction between a hospital and a patient. So what happens is that this laboratory revenue also needs to be given adequate importance, because that can be significant, unlike the canteen revenue, which I was mentioning earlier. So we need to look at this laboratory as a separate service center, and it can have dependent projections, in the sense that it depends upon the other departments, whether the projections will be achieved in a particular fashion or not. But at the same time, this laboratory should be given sufficient importance for the purpose of projections of, let's say, income, as far as a hospital is concerned. And insurance can also be another area. This is not just like a revenue stream as far as an entity is concerned. Insurance is another matter where probably there are situations where the revenue comes from the insurance company directly rather than the patient. That is the only reason why I have included insurance as a kind of a revenue stream. So what happens is that instead of the patients paying directly to the hospital, the revenue may come from the insurance companies, and partly from the patients and partly from the insurance companies as well. So this also has an impact on the revenue classification. Sometimes what happens is that the hospital accounts for this revenue stream separately. Whatever is collected from the patient and whatever is collected from the insurance is accounted separately. And this has an impact. As far as we are concerned, we are looking at one particular service. We may have to club this revenue as well. So on the one hand, I am saying that we need to go deeper into the revenue streams and dissect between different streams. And there could be circumstances where I'm telling you that some revenue streams have to be clubbed together as well. So these considerations can apply. If you do it as a statutory compliance, I mean, if we perform valuation as a statutory compliance, chances of we getting the time to go deeper into these revenue streams are possibly limited or constrained because of the immediate requirements that the entity may have. But when we do it for the purpose of expansion, when we do it for business considerations, it is possible that we can get as deep as possible into the revenue stream itself. Significant time, in my opinion, should be spent into the revenue streams of the hospital. While I began by talking about a hospital which incurred significant losses and where I had a challenge in adopting the method of valuation, most of the hospitals, in my opinion, would go by the income approach because of the income earning potential, which could far outweigh even the capital investment, even though initially it may be higher. So generally, it will be the income approach which will have most significance as far as valuation of a hospital is concerned. And that is the reason why I thought that I will spend more time into the revenue part of this particular entity. And that is when I was discussing about the different types of revenue that the hospital may earn. So let us look at the different items of revenue. This is not an exhaustive list again. This will be purely an inclusive list. What I found was that every hospital which I looked at provided additional revenue streams which are disclosed separately. So probably it is all about disclosures. It may have different sources of revenue. To what extent it discloses these separately is dependent upon the uh, reporting system of that hospital as well. So income from pharmacy can be one source of revenue. Income from the procedures, even the procedures which are adopted by the, I mean the diagnostic procedures and the medical procedures that the hospitals perform. This is also accounted separately. Then scanning, X-ray, investigation and such laboratory services are again accounted separately. So IP theater is also significant in the sense that it is not just like all the procedures are performed only in the theater or outside the theater. There is a bifurcation in this particular regard as well. So I have seen most of the hospitals will report and account for this IP theater revenue separately. So this is also another revenue stream that we may have to consider, even though it is dependent upon the diagnostic service. The predominant service of diagnosis determines whether the patient should get into the operation theater or not. But at the same time, this is like a linked revenue. So in hospital, what I find is that there are independent revenue streams and there are dependent revenue streams. So how far you are able to segregate these two and prepare the projections will ultimately determine the quality of our valuation ultimately. Then there are certain kinds of incomes which the hospital earns like a package. Like probably this is a situation where a hospital says that a particular service will be provided for a particular sum, a fixed sum of money. Let us say it can be 25,000, it can be 50,000 rupees. And then the patient gets inducted or admitted for that particular service. Then what happens is that in this particular situation, the overall revenue is fixed, but the bifurcation of revenue into goods and services can vary. What happens in this particular situation is that, say, a patient gets admitted for a particular service. I have seen this for IVF packages generally. So there is a package-based revenue model which the hospital follows. So the patient charges, patient gets charged a fixed sum, like it can be 25,000 rupees or it can be 50,000 rupees, etc. And then what happens is that depending upon the number of days that the patient spends in the hospital and the kind of consumables or medicines which are supplied, the service income gets billed as the balancing figure. So suppose materials worth or goods worth 20,000 rupees were consumed for the purpose of the service, then 5,000 becomes the service income. If the goods worth 22,000 gets consumed, 3,000 becomes the service income. So this is one practice which I found in one particular hospital. So what I found was that the hospital charges a fixed sum, whereas the segregation of goods and services purely depends upon how much goods are being used, how much medicines are being consumed, or other consumables which are used in the particular procedure. So the service income can vary from patient to patient. So this was one challenge which I faced as a valuer in projecting that particular revenue, where even though it is a fixed sum, now we need to look at only how many number of patients will avail the service. We need not segregate between goods and services in this particular case because it is variable. It depends upon the patient's condition and the doctor's diagnosis. So that was another peculiar situation where I found that the goods and services income has to be clubbed together. Now we are looking at only the number of patients who will avail this particular service for the purpose of projections. Now, room rent, depending upon whether somebody becomes an inpatient, this room rent can be a requirement. And for all the inpatients, room rent will be on another separate revenue stream, even though it is incidental to the main service of admission of that patient for a particular treatment. Now, the bystander is also charged separately by some hospitals. This is a strange practice, but generally hospitals will charge the patient and they will allow one bystander. But I found a rare situation where a hospital charges the bystander separately, which was quite surprising. And I was even wondering whether the regulations would permit a hospital to actually do so. But again, a hospital will do so only after taking care of all the applicable regulations. But I found this rare situation where a bystander was also charged separately, which again can affect the projections provided you look into it scientifically. And consultation only. This is another situation where the patient goes to the hospital only for consultation and medicines are not procured. So this is also a possible situation. It can arise in cases where you go to a hospital for physiotherapy or yoga treatment only as a method of treatment rather than a fitness activity. I mean. So this can happen where only consultation revenue flows from such patients. Registration obviously is a mandatory requirement. So registration fees is separately charged irrespective of the nature of service that a patient may avail. And it sometimes can depend upon the doctor. So you have seen that some doctors uh, consultation requires higher registration fees to be paid in the hospital. So my point is that the scientific projections would involve this particular factor also. Depending upon you are projecting the revenue, depending upon each doctor as well. You may have to even look at doctor as a revenue center and sometimes project revenue accordingly. How many visitors are there for a particular doctor and how much registration fees charged by that particular doctor in the hospital, I mean, can be a factor in our projections as well. In some cases, I have found it significant because there are some doctors who will charge, I mean, for whom the hospital charges 500 rupees as registration fees, whereas other doctors may be consulted by paying a registration fee of just 200 rupees. So it can have a significant impact in the overall picture, though individually it may not be very relevant in the materiality levels. Now, review. I have seen that hospitals account subsequent visits separately from the initial visits. So there can be outpatients who visit the hospital initially and they go for review. I have found that even review is accounted for separately. And in my opinion, even this has a significance. See, basically, how many patients actually go back for review? We may not actually go back for review ourselves because we have found that the initial prescription itself worked for us and we were okay and we did not feel like going for review again because we felt that we did not, need not require that particular review visit. But there are patients who, in fact, since the doctor insisted, they will definitely go for review as well. So this is a situation where review income also may need to be projected separately. So I'm trying to make it as scientific as possible, even though it can be quite challenging. We may wonder how much time would be required for this particular exercise if we go deeper and deeper into it. But depending upon the accounting system that the hospital has, it is possible for us to uh, take these factors into consideration separately. But if the accounting system does not capture this information, or whether the ERP, even the patient ERP management software, do not capture this information properly, then this can significantly increase the challenge as far as a valuer is concerned. And if such a challenge arises, then we may have to look at the caveats, limitations, and disclaimers as well. Because if the revenue streams are not clearly established, and we end up projecting the total revenue based on the overall growth rate, then for me, this is a significant constraint as far as the valuation assignment is concerned. So in a hospital valuation, if we look at revenue streams and its bifurcation to the maximum extent possible, then we are safe as a valuer, in my opinion. But otherwise, we may have to look at the caveats, limitations, and disclaimers because according to me, this is a significant limitation. If the revenue streams are not clearly distinguishable from the information system, which can be the accounting software or the patient management software. Then we are looking at even minor things like even anesthesia is recorded separately as income in hospitals. It is because there are some situations where the patients will not insist anesthesia, and there are some situations where it is mandatory required to be given. So in both these situations, I have found that hospitals go deeper. In fact, even though I say that predominantly the hospitals are run by the doctors, I still find that they give a lot of significance to each of these core areas or even minute areas of revenue streams separately. They give a lot of attention to this particular aspect due to which many hospitals are successful, in my opinion. Then training. This is properly a education activity, educational or academic activity where the hospital provides training and the hospital may get income from that particular training programs as well. So this is a separate revenue stream by its own, and this also is significant in some hospitals, not in all hospitals probably. Then referral fees. See, we have seen referral fees is something like you refer somebody to some place and you get some revenue for that particular referral. This has nothing to probably do with healthcare. It has only to do with one medical professional referring another entity or medical professional in another entity, and revenue comes for that referral purposes as well. Then profit sharing. Technically, hospitals or medical profession is supposed to be run as a not-for-profit motive, in the sense that you are not supposed to run this profession for earning profits. But even though profit earning obviously is necessitated as far as going concern is concerned, and obviously every businessman will look at profitability, but medical professionals are not supposed to extract maximum revenue from the patient. They are supposed to ensure that the patient do not spend much for the treatment as possible. And but the hospital is a separate establishment from the medical professionals who probably provide their services in the hospital. So as far as a business establishment, which is a hospital, profit sharing can be a good objective. But as far as the independent medical professionals are concerned, they are supposed to follow ethics and ensure that they don't extract revenue from the patients more than what they are actually required to pay in that particular situation. So profit sharing revenue is an arrangement where there can be an agreement between two hospitals where patients undertaking treatment in one particular hospital may be sent to another hospital for subsequent procedures to be followed. And there is some kind of a sharing pattern of revenue between these two hospitals. So this is also another revenue stream. So I initially mentioned in the initial stages of my presentation that it is not always B2C service that a hospital may provide. There can be a B2B element as well. So the profit sharing comes from that B2B element of, let us say, running a hospital. Then the incidental revenue, which I mentioned regarding canteen, special camps. Now, many hospitals organize camps, medical camps at various locations, and even that is accounted for separately. I have found that even in some conferences that we attend as valuers, there is a medical desk which is supported by a particular hospital and which provides this medical support facility for the duration of this particular conference or seminar, which can be merely for 2 to 3 days. So this revenue from this medical camps and special offsite, let us say, camps which are established by the hospital is also treated separately in many cases. And this can sometimes be significant depending upon the extent up to which the hospital provides such services. And we have seen that there are further revenue streams in hospitals in addition to what I have included in this particular situation. I have included parking fee. So some hospitals will charge the parking fee as well. So it is like they don't spare any source of revenue which is possible to be earned. So it is possible that the hospital may charge a parking fee separately as well. Now, what would be the other revenue streams? See, basically, if you look at it, it is basically goods and services. It is healthcare services as an umbrella. But under that umbrella, there are several sub areas or units from where you might earn revenues, and that can be quite significant as far as valuation is concerned when it comes to the projection of income. So, what can happen is that a hospital can have additional sources of revenue apart from whatever I have mentioned so far. And one important aspect which I noticed talking about the revenue items is about the unreconciled patient. I am sure that those who have already valued hospitals have seen this particular item in the financial statements, unreconciled patient control account. So this it is called by multiple names depending upon the terminology used by the particular entity. But this is like a hospital can have faced this challenge. There are several persons who pay money through various platforms. It can be cash, it can be UPI, it can be credit card. And there are several situations where we have seen that the money gets debited, but it does not get credited to the other side. And it gets credited subsequently, uh, either to the entity or it gets credited back to the person who transferred that money. So I have seen several cases where the revenue has flown into the hospital. I mean, the money has come into the hospital, but the hospital is unable to identify the source of this revenue. And as such, the funds are parked in a particular patient control account. And depending upon the policies adopted by the hospital, this uh, patient control account may not automatically be treated as an income. Why? Because invoices are already raised to these patients and the invoice has already been accounted as an income. So I'm speaking from the accounting terminology for a few minutes now. So primarily when the invoice is raised by the hospital, it is treated as income. So when there are unidentified receipts, normally hospitals follow this practice of reducing the patient receivables using this particular patient control account for the purpose of preparation of financial statements. So there could be unidentified receipts where the patient whom paid the money, it can come from a third party. See, if you look at it from this perspective, even a third party can pay money for the treatment of a particular patient. It can be the bystander himself in most of the occasions, or it can be another person who transferred through UPI from another location as well. Maybe from the QR code which we transferred the money to the hospital from a remote location, and the money may come from another person which may not be linked to this patient. You may look at it like an internal control failure, but I have seen that practically it is quite difficult when we are looking at lakhs of transactions in a particular day, where each receipt needs to be mapped with a particular invoice. So it is not necessary that the entire invoice is paid in one shot. It may be paid in multiple, let us say, tranches of money as well. And multiple invoices can be paid through a single transactions as well. So this complicated this entire process. And there are credit card receivables, credit card receipts, I mean, there are UPI receipts, there are NEFT receipts, there are cash receipts. So sometimes the UPI transfer becomes unsuccessful and you may pay cash. And subsequently, the UPI transaction also comes into record. Unless the patient comes back and claims this money, claims the refund of this money, the hospital may hold this money. And till such time, how to treat this particular item is a question mark as far as some hospitals are concerned. Now, as far as materiality levels are concerned, I found that in one particular situation, the patient control account constituted 17% of the total revenue of the hospital. So I found this quite significant and shocking that a patient control account can have a balance which is equivalent to 17% of the revenue of the hospital. So while we may look at it as an internal control failure, we may also look at it as the challenge when we can undertake the valuation. So in my opinion, this has additional revenue which needs to be booked in the financial statements. Because when the patient control account has a balance like 17% of the total revenue, it is possible that some items of revenue have not been recorded in the books of the hospital. It is possible that the hospital has not invoiced for all the receipts. That is also one possibility which can arise. And if such a situation arises, in my opinion, that becomes another limitation in valuation as far as we are concerned. And depending upon the extent of information or lack of information, we may have to look into the possibility of disclaimers as well. So in most of the hospitals, I am sure that you will find this item of unreconciled patient receipts. And depending upon the materiality level, we may have to take a call as to how to consider the impact of the same in our valuation assignment as well. Now, let us get into the doctors as a revenue stream as well as a cost expense stream. Now, I told you that the management may consist of doctors, owners will predominantly consist of doctors. Now, a doctor can be engaged as an employee or on contract basis. So, we have seen both these circumstances. So, if we look at the revenue stream, how to project revenue from doctors. Now, a doctor is a visiting doctor in a hospital where he comes only for 3 days in a particular month. So every month he comes for only 3 days or 4 days, weekly once. This can be one possibility. So we need to look at the revenue stream from that particular doctor separately, even though this doctor also provides the same service that the hospital provides as a particular specialization. So we may have doctors who are visiting doctors or who are employed by the hospital or who are engaged as consultants whenever the requirements arise. So there can be a freelance facility where a doctor is consulted only when a requirement arises, rather than on a retainer basis where a doctor comes for a fixed number of days uh, uh, in a particular month or year, as, depending upon the contract. So it is possible that the nature of contract entered between the hospital and doctor can be that of an employment contract, or it can be a retainership contract or a consultant contract as well. So depending upon that, we need to project revenue separately. Now, as far as cost is concerned, we need to look at the cost also from this perspective. Now, after the revenue projections are done, we need to look at the cost projections as well. So a major cost as far as hospital is concerned can be purchase of medicines and payments to medical professionals. Obviously, payments to medical professionals can constitute a major portion of the expenses of that hospital. In addition to the equipments and other facilities which gets factored in the form of depreciation in the financial statements. So when we look at this projection of expenditure incurred on doctors, if the doctors are employed, then we are projecting salary. If the doctors are engaged as consultants, then we are projecting the professional fee which is paid to the doctors for the purpose of this engagement. And this professional fee can be variable. I have found that in some hospitals, it is based on the number of patients which are who are treated by this doctor who comes on a retainer visit. Or in some cases, it is based on time or the number of days which the doctor spends. Or it can be a hybrid model of a fixed portion as well as a variable portion. So if we go deeper, we will be able to do scientific valuations by getting into the appropriate cost centers and profit centers. And doctors is one important profit and cost center as far as valuation of hospitals is concerned. So it can be retainer, it can be visit, it can be employment, or it can be any other form of contract as well. It can be a contract between one hospital and another hospital where the other hospital sends any doctor to this particular hospital based on requirements. So it can be that kind of an arrangement as well. It can be between hospitals as well. Now, let me focus on this particular aspect called the key person impact. I gave you an example where in a particular hospital, it started as a very small clinic and it got developed into a very big hospital, earning a valuation of 800 crores in a span of just 3 to 4 years. It was predominantly because of one person or one doctor in that particular hospital who was extremely famous for his capability or competency and expertise in that particular field. So as far as a valuer is concerned, this becomes one of the key factors in valuation of the hospital as to what will happen to this particular doctor as far as this particular transaction is concerned. Will the doctor continue with the hospital or will the doctor exit that hospital? So in this particular situation, which I mentioned, the doctor continued with the same hospital. And as a result of which the projections had to be prepared accordingly, because this doctor had the capability of multiplying the revenue of the hospital by, let us say, 100 times over a period of 2 to 3 years. This was the capability of this particular medical professional. And in most of the hospitals, we will definitely find one or two key names of doctors who are the primarily the reason why that hospital itself is famous. So in that particular situation, we need to give significant weightage for the intellectual value to be assigned to that particular medical professional who is predominantly the reason for 80% or 90% of the revenue of the entire hospital, even though there are other doctors as well. So as far as a valuer is concerned, how to factor this aspect? Primarily, this needs to be incorporated into the projections and growth rates itself, in my opinion. So depending upon the presence of this particular doctor, a hospital will be able to earn significantly high revenues. And that is one reason why we need to look at the individuals and the human resources in that hospital as well. So as far as a hospital is concerned, in my opinion, it is substantially dependent upon the quality of the doctors who are there in that hospital. And accordingly, human resource has a great significance. It can be even one wing as well. It need not be one doctor, but it can be one entire wing or specialty. Like a hospital is famous for gastro department, or if hospital is famous for the gynec department, which is there, and all the doctors are equally competent. Yeah, that can also be one possibility. So it may not be one doctor, it can be one department, which is the core reason why the hospital earns significant revenues. So in a lighter vein, as far as professionals are concerned, when we were writing the examinations, not the RV examination, but when I wrote the CA examinations, what I found was that there are some subjects where we earn high marks, and this high marks is translated as converting into pass percentage when we get lower marks in other subjects. This high marks will offset that lower marks which we may have got in the other subjects. So same is the situation when it comes to hospitals as well. There are some doctors who are the reason why the hospital earns substantial profits, but there are other doctors who may not provide profitability to the hospital, and sometimes the hospital may incur losses as well due to these doctors. But the overall impact would still be positive because of the impact of that one particular profit center, which is one particular doctor or one particular department. That is also one possibility. Now, the management structure of the hospital also has an impact on valuation. Now, I have seen several arrangements in which the hospitals are maintained. Even though I cannot say that I have valued several hospitals, but every hospital which I valued had a separate management structure. Not every hospitals are run the same way. So, what are the different types of management structure which is possible in a hospital? Either it can be own hospital and you manage it yourself. There could be another arrangement where you own the hospital, but the management is outsourced to a separate team. It is like, it need not even be medical professionals. It can be even other qualified persons who have management expertise, who are interested with the management of the hospital, which means that some of the policy decisions which are taken in the hospital may depend upon the kind of management structure which is being followed. So ownership and management can be separate in some hospitals, where even the owners may not be medical professionals. I have rarely seen situations in my experience in the limited number of hospitals which I had an opportunity to value, where the owners are not medical professionals. Most of the cases, the owners are medical professionals, and management also similarly consists of medical professionals. So this can be one arrangement where the ownership and management can be separate as well, where the management is undertaken by another team of experts. Or there can be a situation where the operations entirely are outsourced. The hospital is owned by somebody, but the operations, it can be partially outsourced or it can be completely outsourced. So not every department in the hospital may be run by its own management. I mean, it can sometimes be outsourced to another hospital or another group of medical professionals, or it can be and outsourced to one particular business entity or holding company as well. So this can be another way of functioning of a hospital. Then it can be like ownership and leasing out. It is also similar to this outsourcing arrangement, but in this particular case, only the lease rentals are collected. Whereas in the former case of operations outsourcing, there is some kind of a profit sharing method which is being adopted. So this can also be a separate arrangement. Now, depending upon the management structure, we need to look at the valuation prospects of that entity as well. So let us pay significant attention to the way in which the hospital is owned and managed, which can have a bearing on the projections that we adopt. Now, there are some case studies which will follow, where I will definitely seek the opinion of members while I will display some figures, and based on these figures, we will have a discussion as on how to look at the performance of the hospital, etc. But before that, let me just look into some of the emerging market trends which are there. With respect to the government regulations and the tax benefits, etc. Earlier, I have seen that as a government, India was unable to give substantial investment in the healthcare sector. But now things are changing. Even when we look at developed countries, there is substantial investment in healthcare, and the healthcare is provided free of cost to the citizens as far as policy of that particular country. Whereas in India, what has happened over many years is that healthcare is not generally free. It can be subsidized to some extent, depending upon the kind of entity which provides that service. But we may also look at possibilities like it can be provided at reduced rate for some patients who are below poverty line or economically backward. So this is also one method in which healthcare is available in India. And now we have seen government schemes, emerging government schemes like the citizen healthcare card, which we have seen for persons who are 70 or above, and who may avail facilities up to a particular limit, depending upon their income potential as well. So for the lower income group, there are some schemes which are being now launched by the government. And this government regulations can also have an impact on the revenue streams of the hospitals. It may not change the footfall of the patients, but sometimes, depending upon the kind of schemes that may get rolled out, it can have an impact on the revenue of the hospitals as well. So, tax benefit as an area was more relevant in the earlier times than today. As far as a chartered accountant is concerned, in my opinion, now the government is moving towards a regime where not much deductions will be encouraged in future. So tax benefit is not one criteria which we may have to figure in future as far as valuation of hospitals are concerned. But this is an emerging change in the field of hospitals. Now, I told you about the technology. We have started consulting using technology as well. I have seen many hospitals which provides online consultation because of the changing times and situations. So, telemedicine is an area which has become a separate source of revenue for many hospitals. It is not always that the patient visits the hospital for availing the service. Nowadays, a significant change is being witnessed in this area where telemedicine is becoming more popular. Technically, doctors will definitely say that you need to look at the patient physically for providing appropriate diagnosis services. But there are certain situations where you may still do uh, uh, justice to that particular situation where you can prescribe over telephone. So it is possible that telemedicine gains more popularity in the times to come. And in future, a higher percentage of revenue may flow from the telemedicine part uh, when we compare with the physical treatments, physical visits which are being undertaken by the patients as of now. Now, another aspect is artificial intelligence in diagnostics. Uh, we are not new to the adoption of technology in medicine. In fact, we have seen robots performing surgeries in hospitals. So it is not just physical human beings which are there. We have seen robots in be performing surgeries even in India, in some of the hospitals. We have seen artificial intelligence to be used in a uh, short, in a minor extent, to a minor extent in some of the hospitals. But nowadays, what I find is that I found last year, in fact, in one particular situation where the hospital heavily employs artificial intelligence for projecting the possibility of whether the disease will become severe in future or not. So I found that it is used even for the diagnostic services significantly in a significant manner by the hospital. So what I found in this particular situation was that the hospital employs artificial intelligence by collecting the data of past patients who have undertaken treatment in this hospital, and this hospital had an arrangement with other hospitals for sharing of this data as well uh, on some kind of a contractual basis, where the database is built of past trends of what happened to the patients who underwent a particular treatment. And I'm just trying to state this out like an example, even though I'm not a medical professional. So uh, there are situations where a person may undergo several kinds of treatments for a particular disease. So you may have a problem of acidity. I'm taking a very common and general example. I'm not taking complex surgeries, etc. For an acidity problem that you may have, depending upon the severity, it can actually lead to further diagnostic procedures like endoscopy or colonoscopy or any such kind of treatment. And it can also get into surgical procedures as well, depending upon the kind of severity. Now, what this AI software does is that it actually studies the past history, and depending upon the type of symptoms that the patients have experienced and the aging of their symptoms, like how long has the patient been suffering this particular symptom, and they take into consider the aging factor, they also take into consideration the kinds of medical treatment which were prescribed and the end result as to how the patients were cured, in what kind of time frame the patients were cured, whether the patients were partially cured or fully cured. And they take all these information and then they project what kind of medicine to be prescribed in this particular case to ensure that the patient gets cured in the shortest period of time. So significant research and investment is flowing in the field of artificial intelligence. And as far as valuers are concerned, the impact is uh, visible in the area of projection of income, as well as looking at the assets of the hospital as well. Because the investment in software is a very big element now, which we find in the financial statements of many hospitals. So there is significant investment which flows into the software as well. So earlier we were looking at the capital intensive nature of investing in machines, specialty medicines, devices, diagnostic devices, etc. Now we are equally looking at the possibility of investment in the softwares and other intangibles elements in that hospital as well. So things are changing over a period of time, and this will have significant impact on the valuation as well. I am sure that BBA themselves have organized seminars on the impact of technology in valuation, and we have had seminars in the past. So it impacts all fields, not just hospitals. It impacts every kind of valuation. And we have seen that entities like there are several entities which come up with softwares even for valuation purposes. So it is not just like the softwares are used only in the industry. Even we valuers use software for the purpose of valuation. I have not yet used any software for valuation, but there could be members in this particular forum as well who have used softwares extensively for the purpose of valuations. It is not just for projections, I mean. And there are some softwares which help you to assess, analyze the data, and then validate the assumptions of projections as well. But I am not an expert in using software for the purpose of valuation, so I will not go deeper into that particular subject. But this is a big possibility. I am definitely looking forward to learning or improving my competence in using some software for the purpose of valuation, which can also help us to comply with the documentation requirements of IBBA as well. So that is also one way of looking at things. It can help us retain the records. It can help us maintain the valuation reports in compliance with the IBBA regulations as a checklist or template or some kind of a system or module which may be there in that software. Now, mergers and acquisitions are becoming more popular in the hospital sector. I have found that there are several hospitals which acquire other hospitals, which keep on.
Nitin, sorry to disturb you. Due
Sure,
to timeless, okay, can we concentrate more on this growth or valuation? Okay, the indicators, what you have taken, more on practical things, calculation things.
Definitely, sure. So,
Yeah.
in fact, after this slide, in fact, we are looking at some of the examples of annual reports which I have extracted, and we will look at those factors as well. Definitely.
Sure. Thank you. Thank you.
So we are looking at this mergers and acquisitions as another possibility where the hospital can have its own subsidiaries and it may acquire other hospitals as well. So that is also one way of looking at this particular industry where significant changes are happening in future. Now we have, I have tried to list out few sample situations where there is a general purpose hospital where it provides services in multiple disciplines. And I have taken a case study of a specialist hospital where it provides services only in one particular department predominantly. So let me just show you the slides, which are primarily the information which I have extracted from the annual reports of the hospitals. So this is where obviously I would definitely seek the opinion of members as well. Now the remaining part of today's session is about these case studies, and then we will get into any further question answers or conclusion. So this is the first information which I wish to present before you. So this is a case study of 3 hospitals and some key figures taken from the annual reports of these hospitals. These figures are in lakhs. In fact, these are rounded in lakhs. So these are big figures which we are talking about. But anyway, let us look at it as a consistent unit of measurement. Even if we assume it as rupees or thousands, these figures are consistently being put in this particular table. So we have revenue from operations of three different hospitals of three different sizes. But when we look at the profitability percentage and the return on assets, etc., and return on equity, all these hospitals provide different situations. Now, let us look into the case study. Now, I want members to give their opinion as to which hospital is performing better with respect to let us its efficiency. With respect to turnover, obviously the figures are right in front of you. Which hospital is bigger than the other is quite obvious. But when it comes to efficiency, which hospital amongst these three is functioning better? So I would like to get the opinion of members as well now. I have given figures for 3 years for better analysis as well. It is not just 1 year that I have presented. So we can take the information about the trend of this hospital as well, and then try to analyze which is doing better.
I think by looking into the figures, hospital one is hospital one, sorry, hospital two is giving the better returns, performance wise.
Yes. So return on equity, when you look at it, it is highest in the case of hospital 2. But in absolute figures, obviously, there is no doubt in our minds that hospital 1 is the biggest in size, as well as the absolute figures of returns. Now, even if you look at the profitability, it is not bad in the sense that you are looking at this profitability, high profitability, double-digit figures definitely for hospital 1 and 2, and return on equity also in double digits. So for hospital 1 and 2, we are looking at two different sizes. One is a very large hospital, another is a small hospital comparatively. But when it comes to efficiency, now if you look at the figures, there is a zigzag pattern as well. Now this is the point which obviously Venkata Subbarao sir was also looking at, like the challenges in valuation growth rates, focusing on certain similar situations, etc. So I would prefer to get the opinion of others as well regarding the trend that we see in this particular table. Like there is an upward trend, there is a downward trend, the zigzag pattern of returns as well. So what is your opinion on the pattern of revenue and returns?
The growth in revenue in hospital 3 is like really good. If you see first year to second year, almost 50% growth, while the hospital 1 and 2, you're not finding a similar growth.
Yes. So that was also another important point. Even though the figures we were looking at is in single digits, but the pattern of growth, if we look at the future, the kind of growth which is witnessed in hospital 3 indicates that it can actually become as big as hospital 1 over a period of probably 5 years. It is possible. Whereas the hospital 1, it is almost like a matured hospital. It has already reached that kind of a saturation level, where unless it expands and acquires another hospital, the revenue growth rate might be slower or lower than that of the other hospital. That is one possibility. Then
Actually, if you link this to the very first question you asked at the beginning of today's webinar, you asked if the hospital run by only doctors is advantageous or disadvantageous. Maybe it will be interesting to see what is the combination of the management in hospital 3 versus hospital 1. Maybe you will get some inputs where you can draw some reference, because these days administrative capability is also very important, which doctors might not generally have, right? So those kind of cues also can be drawn here.
excellent. So that is a very good observation. In fact, obviously, when we look at the future growth potential of the hospital, we need to definitely look at the management capabilities as well. So the expertise of management, and I also mentioned the key person impact as well. So it could be due to one person that the hospital earns this kind of a growth rate. That is also quite possible, or one department, as the case may be. So that is also one way of looking at this particular case study. Now, talking about the return on assets, is there any opinion with respect to the return on assets and the pattern in these hospitals as to what is which is doing better?
I think so. It's hospital 2, which is giving good returns on assets comparatively to hospital 1 and 3.
Definitely. So, what could be the reasons why, even though it is the smallest hospital, it still provides good return on its assets? Uh, in this particular case study, I have taken only hospitals which are into multiple disciplines. It is not just like an eye hospital versus a general hospital. I have taken only hospitals which are into multiple disciplines, multiple departments. But even then, segment information can be a very important information. Everybody will appreciate that this table is not sufficient to gain complete insight into valuation of a hospital, but this provides some initial insights as to how to begin with. So this is just a starting point of evaluation, which we may adopt for projecting the growth rates, etc., of a hospital, where we find that the return on assets is higher. So does this have an impact on the approach that we may adopt? Let us say if the return on assets is higher, does it actually make income approach more suitable, or does it actually make cost approach more suitable, is also one question that we may have in our mind. But generally, when the profitability is getting better, we might be inclined to follow the income approach more. So if we look at the return on assets, definitely hospital 2 provides much better return on assets. Now, there is another aspect which I would like to highlight, the zigzag pattern which we can find in case of hospital 1. You have seen that the revenue of the hospital 1 has increased consistently from year to year, but the profitability follows a zigzag pattern. It is not just like directly proportional to the increase in revenue. So what has happened is that the hospital 1 have not managed to maintain the same level of profitability in that increased revenue size. So this is visible on the return on assets. But interestingly, if you look at the return on equity, what happens is that the return on equity has increased in this particular situation. So these zigzag patterns is one challenge which obviously the valuer faces. So if you look at the return on equity, it is like the second year is better for hospital 2 and hospital 3. Whereas in case of hospital 1, it is the best in case of year 3, which is the current latest year. So zigzag patterns in revenue, profits, return on assets, and return on equity. So what is the factor on which we should place maximum weightage, whether it is the revenue increase or whether it is the increase in profitability or whether it is based on the return on assets or return on equity? So this is where obviously I'm sure that there will be multiple opinions coming across. So as far as income approach is concerned, revenue will have significant weightage, definitely. So when we adopt the income approach, we need to give a lot of importance to the revenue earning potential. Now, for this hospital, for these hospitals, I mean, what kind of growth rates can be adopted in future? So you look at hospital 1, which has a consistent pattern of increase in revenue. If you look at it, and the percentage is consistent. When we look at hospital 2, it is like a zigzag, slightly zigzag pattern. There is not much variation between second year and third year. But when we come to the hospital 3, we find a significant growth in the potential. So these hospitals are probably in different stages of its life cycle as well. This is where the comparable information extraction becomes very much challenging. So what happens is that hospital 3 is in the probably infancy stage, where hospital 1 is in the maturity stage. Hospital 2 is probably also in the initial stages of its functioning, or it can be a matured hospital as well with saturated objectives or intentions of the management. So this is one particular table which I thought that I should include here for analysis purpose, which proves that the pattern in revenue may not be consistent with the pattern in profitability and the pattern of return on assets. So we need to decide which factor to be given maximum emphasis and accordingly carry out these projections. Now, since there is a downward trend in profitability, there is one specific question which I would like to seek opinion of the members. Now, hospital 1 has higher revenue in the third year, but lower profitability. So as far as valuer, if you are supposed to project for the upcoming 5 years, how will you project? Now, we have seen that there is an increase in revenue, but there is a decrease in the net profit margin. So, in your opinion, how will you project the profitability for the upcoming years? Obviously, management is supposed to provide us the projections, but how will you validate the assumptions? So, will you actually project this decline in net profit margin, or will you actually project an increase in the profitability in the same proportion of third year? Or will we take the average net profit margin for the past 3 years and do this projection? What method do you suggest as experienced valuers? Let us stick to hospital one only. And we are looking at the increased revenue, but zigzag pattern in the profitability and return on assets. So how do we project for the upcoming 5 years? What will be the growth rate that we adopt for net revenue and expenses? Or you can give your opinion on any other factors to be considered before projecting this revenue as well.
If there are any exceptional, extraordinary items that has resulted in this zigzag pattern, first that needs to be identified, and we need to what do I mean? What do I say? Even it out for the projections. But if there is nothing like that, I would generally go for an average approach.
Correct. So this is a good insight. In fact, I hope that most of the members would agree with this particular view, in the sense that if there are exceptional items due to which, see, there can be another situation. In the second year, probably there was an exceptional revenue item that due to which there is a significantly high net profit margin of 16%. You see the jump from 11% to 16% in the second year, while in the third year it came down to 14. So sometimes it is possible that third year is the normal scenario and second year was the exceptional scenario. So probably we have to study each and every year and the pattern and analyze whether there is any zigzag trend or abnormal items or exceptional items. It need not be always abnormal. It can even be some exceptional situations where, for example, management started heavy capital investment, due to which there is a depreciation impact on the net profit, due to which the profitability came down for the third year. This is also possible. So if we look at exceptional items, we need to remove it and then project it properly.
Could be there's one more thing. There could be a industry pattern, because we see that for each of the entities, correct, the profit dips in the third year, while it is higher in the second. Again, it dips in the third year. So that could be a phenomena in the industry, that there's a boom in 22-23 because of, let's say, COVID or something like that, or some such situation, and then now it has come back to normal.
Yes, obviously, yes, correct. In the sense that we were talking about the exceptionally higher profit margin in the second year. So obviously there was something which happened in the second year in the entire industry. It is not probably confined to one particular hospital. It was an industry phenomenon. It can be pandemic, or it can be government policies as well, or it can be some kind of new technologies or new kinds of services which were introduced in these hospitals, which significantly resulted in that change in the second year. That is also quite possible. So I think we have discussed a few aspects about this particular situation, and we will just look at the other aspect as well. Now, I was focusing on the net profit. Now, let us look at the operating profits of these three hospitals. So the previous slide, we have seen some patterns. Now we are looking at the operating expenses and operating income for the same hospitals, 1, 2, and 3. So if we look at it, operating expense, there is something unusual if you look at the hospital 3 with respect to the operating expenses. So what would be your opinion on such significantly low operating expenses, and as far as valuer, how are we supposed to approach this particular situation? Any opinion on this?
Maybe hospital 3 is in tier 3 city or something.
Okay, that can definitely be one possibility. Yes, it depends upon, let us say, the location, and it can have an impact on the operating expenses. But this operating margin of 97% or 98% is possible due to various situations. One significant thing which comes to me as an auditor is that it could be due to wrong classification of expenses as well. in this particular situation, when we look at all three hospitals, 70%, 73% or 71% is the consistent percentage that we find in case of hospital one. Even though the net profit had a slightly more variance, higher variance, but the operating profit is generally consistent. So which we can say that hospital one is doing really well in this particular aspect with respect to maintaining its consistency. But when we get into the hospital two, there is some kind of a decline in the operating margins in the second and third year. So which can indicate a trend into the future as well, that it may not come back to the same level as it maintained in or it achieved in the first year. But in case of hospital three, it is like a significant profitability position as far as its operations are concerned. So apart from being in, let us say, particular locations, is there any other factor which can contribute to the significantly low operating expenses and higher
The doctors
revenues?
are not taking remuneration. Doctors will be taking the profit at the end instead of as remuneration.
Okay, okay, definitely. That is also one possibility that we can consider. Okay, then. As a skeptical person, I was looking at the incorrect classification of expenses as well, because probably the accounting treatment can have a impact in the sense that whether you treat an item as indirect or direct expenses. So especially with respect to payment to doctors. So the payment given to doctors, if it is treated as an indirect expenditure to some extent and direct expenditure to another extent, it can have significant impact on the operating profit figures, which we look at in this particular table as well. So looking at this, there is one advantage for hospital 3 in the sense that significantly high growth rates when compared to hospital 1 and 2. That is one thing which we noticed. Another aspect is significantly low operating expenses, which can actually mean that obviously the nature of service may not require that much materials when compared to the nature of service which is provided by other hospitals. That can be one factor as well. But hospital 3 provides good scope for future if you look at this particular analysis pattern, because of the high operating profit as well as the growth rates which we have found in the case of this hospital. But there can be some inconsistency when you look at the return on equity and return on assets. So all these can have an impact on valuation. Now, let me get into a specialty hospital. Practically, when we compare similar hospitals, whether it is general or specialty, it may not have much of a difference. So you can merely take this as a separate case study of comparing between two entities. Only that one hospital is specialized in one department. And in the previous case studies, the hospital was all the hospitals were into multiple departments. Now, this is a situation where the hospital is into mainly one area of a specialty. Now, let us look at these patterns. So, how do we project this valuation? This is the second case study which I have taken. I know that it is already 9:30, but this is the important aspect where I would like to get your opinion, where you find the third year figures. So, how do we proceed within valuation when we find this kind of negative trend in the third year when compared to the first 2 years? We have seen a decrease as well. If you look at the pattern, there is a decrease every year, which is visible in case of hospital 4. Whereas in case of hospital 5, the situation is not possibly as bad as that is in the case of hospital 4. So how do we project when the relevant immediate recent year has a negative profitability? As far as valuers are concerned, how do we look at the situation?
I think first of all, you need to ascertain what has actually led to, the negative profitability, right? What could be the reason, whether it is, technology, whether it is people, doctors not being available, and moreover, it is supposed to be a specialty hospital.
Correct.
Maybe the
So I think
special doctor might have not, say he might have happened to say something to him, and that may be the reason. Because
Yes.
mostly the hospitals depend on one single big doctor. If
Correct.
he's
So,
not available, people may not turn up there.
Exactly. So this is the only reason why I took up this specialty hospital as a separate case study from a general hospital. So even though there could be zigzag trends in both these situations, a specialty hospital primarily depends upon a key person or a department. So there can be significant uncertainties or variations in the profitability depending upon what has happened in that particular situation. Or there could be another situation where there was a medical negligence in that hospital. A news broke out regarding a medical negligence in that particular hospital, due to which the inflow of patients suddenly declined. And that could be one reason why this hospital may have incurred a loss in the third year. So that can be one reason. A key person may have left that hospital. Maybe the key person passed away and the next generation has taken up this hospital, and it may take time for them to bring the hospital back to the previous level of profitability. So in all these situations, the essence is that we need to go deeper. So there is absolutely no doubt that these figures should be analyzed with respect to the factors which contributed to the increase or decrease, and a careful analysis should go into these situations, even though the management will always project positively. The challenge for valuers is to go beyond that positive projections and look into these factors which may have an impact on the future earning potential of that entity. So this can be a significant factor when it comes to this particular situation of valuation, especially in a specialty hospital, where it depends poorly, mainly on one core a doctor or one person who is a key professional, or one set of doctors in a particular area. So these are also other factors which may have a role to play in the assumptions and projections that we use for the purpose of valuation. Now, anyway, I had projected these growth rates as a percentage separately from year to year basis. This is merely for understanding. This is the same case study which I had presented in case of hospital 1, 2, and 3 in the first slide. I mean, the pattern of revenue growth, if you look at it, hospital 2 has a negative growth in the second year. But when we look at the hospital 3, it has significantly higher growth rates, as we have seen. And the profit growth rate. So it is not just the pattern of net profitability, it could also be the pattern of change over year to year, which can have an influence on the valuation. So we should start having this analysis, or we should also do this more extensively rather. We are already doing an analysis of ratios, but I suggest that we go deeper into the calculations on year to year basis as well, or a average trend over a past 5 years, 3 years, etc., and try to project the future. This can significantly reduce the, let us say, fluctuations in the valuation between one valuer and another valuer as well. And I have done the same with respect to EPS growth rates and the assets growth rate for the same hospitals over year to year basis. So it is just like a trend analysis, or it can be like variance over 1 year when compared to another year. This is also another type of comparison which we can do for the purpose of analysis. But this is only the basic figure. Starting from here, we need to analyze the reasons for these increases or decreases by going deeper into the financials, and then that will give us an insight as to how to proceed with in this particular valuation assignment. I have done the same thing for this specialty hospitals as well. So you can find the negative profitability pattern which is there, and the negative pattern increases over a period of time. So that casts significant doubts as to the subsequent projections, or we may have to project loss in the initial years, and then it needs to get back into profitability over a period of time, possibly. But that depends upon whether that specialty will get sustained as such. I have seen a specialty hospital getting converted into another department or another specialization because the key persons left that hospital, and they could not carry on the same kind of specialty which they were engaged into previously, and they have changed to the specialization, which will have a significant impact on the assumptions once again. So the change in the intention of the management also has to be given adequate weightage. And anyway, I'm not discussing this particular slide further because this is just like how I did for the previous hospital as well. So it is the specialty hospital EPS pattern, which is anyway consistent with the asset and the profitability pattern. So are there any further questions? Since anyway, we have reached 9:30 now. So are there any further aspects which can be taken up quickly? We can do that as well.
Sir, just wanted to add one more question. Is there a possibility to compare tier 2, 3 cities hospital with the tier 1 cities? And what is the revenue per bed indications? What way we can compare those with tier 2, 3 cities with 1 cities? If you can just draw a light on that.
Okay, so basically, when we look at the tier 1, 2, or 3 cities, etc., what can happen is that the expenses can vary, the profitability can have a significant variance with respect to these areas. So the multipliers that we can adopt is a challenge which we generally face in valuation. So the per bed is one calculation which most of the hospitals follow. In fact, as you rightly pointed out, the revenue per bed, like a hospital with 500 beds, a hospital with 300 beds, etc. So all those have had significant bearing on the multipliers that we adopt. So we can compare with between tier 1 and tier 2 cities, but the comparables require more adjustments. So generally, we would prefer the hospitals in the same tier city. And if that is not available, only then I will suggest going for comparing with the hospitals in other cities. But what happens is that in case of hospitals, you will definitely find comparables in similar tier 1, tier 2, or tier 3 cities itself. So that you need not practically go into tier 1 or 3 unless it is into specialty. For general hospitals, you will definitely find comparables in the same tier cities. But for specialty hospital, it is possible that we may have to undertake this additional challenge of ascertaining the multiples which we may have to adopt for the purpose of converting that figures for comparison. So this can be based on number of beds essentially, but it can be based on the department profitability as well, like which department brings maximum revenue to that hospital, and we need to look at that particular aspect and also give more weightage. So what I suggest is a weighted average analysis of multipliers. Rather than looking at only the per bed revenue, we may have to further give weightage to the department or core areas of revenue or profitability for those hospitals in multiple tier cities as well. So that is one way of looking at this scenario. If there are any other
Also,
yes.
yeah, I just another question is, we spoke about comparing hospitals in, different cities. What about large chains where their, hospitals are present in like an Apollo hospital, which is actually present in various parts of the country. It is also in tier 1, tier 2, and also in metro cities. So, is there a different benchmark that needs to be used for valuing large hospital chains?
Okay, there is anyway one aspect called segment information. So the segment information, depending upon its applicability, the hospitals generally will maintain the records of definitely location-wise revenues as well. So as you rightly pointed out, this possibility is also there that a hospital may have presence in multiple tier cities as well. So and consolidated revenue is being projected for the hospital. So definitely location-wise revenue has an impact, and we need to again segregate. The easiest method is to segregate the revenue from multiple locations and multiple centers, and then do the comparison accordingly. So even though we may take a hospital as a whole, we may take the revenue from a particular location and use it for the comparison purposes, provided we get sufficient information. So there the challenge is about extracting relevant information from the let us say segment information which is available in the annual reports. So annual reports is one source of information from where we can possibly extract the location-wise, geographical segment-wise revenues and department-wise revenues to the extent the hospitals disclose the same. So disclosures will have a significant role to play. In the absence of the same, then we may have to look at, let us say, caveats, limitations to some extent. Even though it is possible that we may get substantial information, we may not get the complete information which gives us a confidence that the validations can be, the assumptions can be validated properly. So segment information is one additional aspect that we can consider. And then we need to ideally compare between segments rather than the entire hospital. Any other factors?
Just to add to my question, sir, previously. So generally, in case of tier 2 or 3 cities hospital, if there will be a difficult chance to get the multiples in the open market, because see, those hospitals are neither in a listed space and all. So now let's say if one of my client is having a hospital in tier 2 and 3 cities, they are acquiring other hospitals. Now what way we can benchmark that revenue per bed with the other hospitals, that would be a difficult challenge, because promoter is asking some XY multiples, and if I am defending saying X minus Y minus 2, so in that situations it would be a very challenging task to get the required multiple on the platform. So if you can just throw light on that, what way we can do that things.
Okay, this particular aspect is not specific to a particular industry as well, in my opinion, because there are multiple industries where this is a common issue of not having enough comparables to carry out this valuation. Now, see, if management has an assumption, they should have a base for this purpose as well. So if the management adopts a particular multiple, and we do not have sufficient information to contradict that particular situation, then the only possibility is to ascertain the basis of arriving at that particular assumption or multiple by the management. So on what basis did the management conclude that the multiple will be 5 times, or whatever be the figure that the management determines appropriate? If it is merely based on their desires without any scientific calculation on their part, then obviously as a valuer, we may have to play a role in fact, correcting that kind of assumption and bringing it back to reasonable trend based on the past, in fact, performance. So, in fact, past performance could be the only source of information when we don't have enough comparables. So, there could be a situation where management adopts a multiple, but we do probably feel that it is high, but we don't have sufficient information to contradict. Then, asking management to substantiate to our satisfaction is a call that the valuer will have to take. This is the general solution which comes to my mind. And if there are other solutions, if experienced members can throw light, I would be glad to gain that.
No, so I have a question here. Okay.
Yes.
Hospital industry is a matured industry. I mean, people have been sick for ages, correct? And this industry has been running for hundreds of years now. And it
Yes.
is a matured industry. It's not a new industry like a software industry or something like that. So why multiples can't be established? Correct? On such a
It is only
situation?
the segment-wise information which becomes a challenge. The overall information obviously will be available. If you look at most of the annual reports, it will have sufficient information with respect to the overall functioning and total figures. But when it comes to segment information, the challenge which I found was that most of the annual reports do not give sufficient information or complete information of the segment-wise revenues, which becomes an important factor in valuation. So even though information is available, the industry is matured, obviously. The segment information disclosure is something, the lack of which creates higher challenges as far as valuations are concerned. This is one
So it's
aspect.
a data that poses a problem, correct? The availability of
So
data.
in that case, should actually, a regulatory body should intervene and should ask that, disclosure should be made, by, hospitals, particularly, corporates engaged in this particular sector. This is the sort of disclosure that is required. Should that become mandatory? Should there be representation that needs to be done to ask for information?
Okay, that is a point which we have to look at from the institution level rather than the individual valuers level. But again, when we get into segment information, there are accounting standards which are applicable, which determines to what extent the segment information should be disclosed. And I find that most of the hospitals only go by the minimum mandatory requirements, and they don't get into the additional information which may help the users. So they don't voluntarily disclose information which can be relevant for obvious reasons, that they don't want that much information for the competitors to access. Since the industry is already matured, obviously the information is easily available, and that prevents the management from disclosing information which they feel that it can backfire as far as the hospital is concerned. In the, let us say, form of in the guise of transparency, if we disclose too much, then it can affect the future of the hospital as well. So there is a sensitive information as well in this particular area, due to which there is a limit up to which I feel that the additional disclosures can be mandated by regulation. So probably location-wise revenue, department-wise revenue is an information to an extent of reasonability. We can insist that it can be disclosed, but beyond that, it can be a challenge.
Yeah. Thank you, Nitin.
Yes.
Thank you very much for your wonderful session where you have covered all the points, okay, from starting with IVS, okay, as you said, like in 2022 and 2025, the weighted average method is not allowing that one. And anyhow, we are going to have a discussion on that International Evaluation Standards New 2025. And I would like to take this opportunity to thank for your wonderful, excellent presentation on hospital valuation, especially, okay, where you have covered not only valuation, which you have covered, okay, finance modeling, like how we need to look into the different streaming revenues and expenditure and tier 1, tier 2, tier 3 cities, and also some like, as you know, that some hospitals also they do manufacturing, like Apollo and all. They have like again medical okay, that equipments or medical tablets and all they produce also. That also we may need take into consideration sometimes. Thanks once again from Bangalore Wealth Association, and okay, we will send you this memento as a token of gratitude from Bangalore Wealth Association to your address.
Thank you
And
very much.
looking forward to more sessions from you. And also, if once we are going to do any international valuation standards, I think okay, you can take one topic on that in the future.
Okay, sure. It will be my pleasure. Thank you very much for
Thank you, Nitin.
providing me this platform.
Yeah, and also I thank all the participants for your active participation. And also I would like to request everyone to member to become the member. Okay, we have the 31st March 2025 where you can get early bird offer. I request everyone to register as a primary member or associate member before 31st March 2025 to get that early bird offer. And once again, happy Women's Day to all of our Bangalore Wealth Association members and all women. Thank you very much. Have a great weekend.
Thank you.
Thank you.
Thank you. Thank you.
Thank you, Vijay. We can close the meeting.
Yes, ma'am.